Hi, do you know the difference between buy to open and buy to close when trading options? They are the differences between an option buyer and an option seller. Today, SlashTraders will show you the pros and cons of buying or selling options, so you know which trading style works better for you. We'll talk about 7 key points today. 1. What is buy to open? 2. What is buy to close? 3. The risk and rewards of the two strategies. And 4. The probability of profits. And 5. The impact of theta decay. And 6. Different ways to close the trades. And 7. Seller-specific option rolling strategy. Buy to open is when you buy an option to open a trade, which is a typical option buyer strategy. A bullish strategy for option buyers is to buy a call. When the stock price goes up, the call option can be exercised to buy shares below market price for profit. A bearish strategy is to buy a put option to open. When the stock price goes down, we can exercise the put option to sell shares above the market price for profit. Buy to close is when you close a short option to settle an options trade, which is part of a sell to open strategy for option sellers. A bullish option selling strategy is to sell a put. When the stock price goes up, the option value will depreciate and the seller keeps the premium for profit. A bearish option selling strategy is to sell a call. When the stock price goes down, the call option will become worthless and the seller collects the premium for profit. So what are the differences and risk and rewards for option buyers and sellers? We open bullish option trades for Microsoft that expire next month to illustrate the differences between buyers and sellers. An option buyer can trade an ATM call by spending $935 in premium. If the stock price goes up, the maximum gain of the call option is unlimited. If MSFT drops in price, the maximum loss for the option buyer is the cost of purchasing the call. An option seller can trade an at-the-money put to collect a $1,095 premium as income. If the stock price goes up to make the put option worthless, the maximum gain is the premium collected. If the stock price drops, the maximum loss for the option seller is buying the worthless stock at the strike price. If we compare the risk and rewards of the two strategies, an option buyer has limited risk with unlimited rewards, while an option seller has unlimited risk with limited rewards. Apart from risk and rewards, we can also compare the two option strategies with the probability of profit. A bullish call option buyer needs to pay a premium to buy to open the trade, so we need the stock price to go up a great deal to offset the cost of premium before making a profit. As a result, the probability of profit for buying a call is less than 50%, lower than buying stocks. A bullish put option seller collects a premium to sell to open a trade, so the break-even price is actually lower than the strike price. A seller can profit even if the stock price doesn't move much, so the probability of profit for selling a put is greater than 50%, higher than buying stocks. For a call option buyer to profit, the stock price needs to move up as expected, while a put option seller can profit as long as the stock price doesn't fall. So selling options is a good way to control the odds of trading in your favor. Unlike trading stocks, options trading has an expiration date, so we need the stock to go our way before expiration to make a profit. As time passes, theta will cause the option value to depreciate. If the option doesn't generate a profit before expiration, the premium paid for the option becomes worthless. So theta decay works against the option buyer but favors the option seller. This allows a patient option seller to wait for the options to depreciate for profit. Now we know how the two different strategies enter option trades, we can look at the differences in closing trades. After a trader buys to open a trade, there are two ways to close the trade. One is to exercise the option contract for 100 shares at the strike price. Another way is to sell to close the trade for cash. An option seller cannot exercise their option contract, so has to wait for the options to be exercised for 100 shares at the strike price, or settle the position in cash with buy to close. A unique closing strategy for option sellers is rolling. This is where the seller combines buy to close with sell to open and extend an option trade to a later expiration date. If an earlier bullish short put option on Microsoft was wrong, it could become in the money at a loss. If we maintain a bullish outlook on Microsoft, we can buy to close the trade at 14 days to expiration, then sell to open a put that expires next month. This way, the premium from the later date put can offset the initial loss. After the rolling transaction, we are left with a short put option that expires next month, allowing us more time to wait for the stock price to rebound in a bullish trend for a profit. Once we understand how rolling works, as long as our prediction about the price trends doesn't change, we can continue to roll and delay the option expiration to wait for the profit from a rebound. Now you know the differences between buy to open and buy to close. Even though an option buyer has a better risk-reward ratio, but an option seller can better control the probability of profit. Not only can a patient options buyer profit from theta decay, but one can also use the scrolling strategy to use future premiums to offset losses and wait for market to rebound. If you enjoyed my video about trading options, please like and share my video and also subscribe to my channel. Thank you.